When the markets are overbought, they tend to go up. When the markets are oversold, they tend to go up. Believe it or not, this is the greatest paradox in markets today. Hey, what's up? I am here today with my good friend and co-host for these Friday editions of the podcast. Got Marshall Johnson here with me.
Hey, what's up, buddy?
Hey, man, I'm excited to be here. This is always a cool opportunity for us because we get to talk about the things that excite us the most this given week, right?
Yes,
we
sir.
sift through all these articles, we read all these articles, we share them back and forth, we have other people sharing articles with us, we read all this stuff, and then you and I will sit back and go, look at this one, look at this one.
One's really
this one's
good.
really cool,
Yeah,
I like
one's
this.
really good.
And we kind of nerd out on these things, and then we go, hey, why don't we share that nerdy conversation with all those folks out there that would find this stuff really interesting, and we take all those articles, we package them into an email, we slim them down to 4 articles, and we drop those in your inbox every single Friday. 4 articles, trending topics, all in the financial planning space, all designed to help you make better decisions and find a little entertainment along the way. We really want to add value to your lives, whether that's what's going on in the markets, what's the latest investment trends, what's going on with interest rates, what's going on with, heck, long-term care insurance, whatever it might be that could help you make better financial decisions, you'll find in that email, along with invites to webinars and giveaways and all kinds of great stuff. If you'd like to sign up, all you have to do is text WR to 866-482-9559, and we will get you signed up to receive that email every single Friday. Today, we are going to be highlighting an article from Compound Advisors written by Charlie Bellello, and it is titled The Greatest Paradox in Markets. And boy, is it a paradox.
There was a clickbait there for me. It's like, I want to know what the greatest paradox.
The greatest paradox, right? It's like there's a lot of paradoxes, but I want to know the best one.
According to Charlie. Right.
Yeah, according to Charlie. Charlie might have some incentives, but we'll get to the bottom of those here in just a moment. But it's a really good article. It points out some things that you may have never heard of before or never thought about before. I think the article is really focusing on 2 things in the markets: overbought markets, oversold markets. And when you think of an oversold market, you think, hey, it's time to get in. You think of an overbought market, you think, hey, I better get out of this thing and run for the hills, right? And that's due to 2 innate human conditions, that is fear and greed. We have a sense of fear, we have a sense of greed, and I think you'll be surprised by what technically happens at both ends of that spectrum.
Yeah, I love this article for the timing, right? We're talking about an oversold market. Markets go down when they're oversold, they go up when they're overbought, and we've seen both extremes here in the most recent history, last 24 months. You look at some of the extreme overbought conditions, and now you've got some extreme oversold conditions. And I think you'll be surprised with some of the data that surrounds those environments.
Yeah, well, it's in fear and greed. You and I always talk about getting those fear glands pumping, getting those greed glands pumping, right? And this is a very powerful thing that you see in the financial services space quite often. You'll see it, I think, more often on the greed gland space. I think depending on the market conditions, maybe you're seeing it on the other side. But quite often you'll see an advisor or a firm that wants to get those greed glands pumping. You sit down in their office and they show you a portfolio that's annualized 25, 30% a year, made 45% last year.
Or a mutual
and
fund.
You go, ooh, I want that. Not only do I want that, but I don't want to miss out on all those other folks that are getting that. I've got to get that right now. I want in. You see that at the other end of the spectrum, people getting those fear glands pumping that are focusing on very specific charts saying, hey, markets down 53%, can take 10 years to get back to even. And, the PE ratio, the Shiller PE is at a 35. The market's going to have low returns for a long period of time. You need to get safe, right? And I think we have to be cautious with both sides of that, whether it's fear or greed. We have to recognize in ourselves, is that gland pumping right now? Why is it pumping? Who got it pumping? Do I need to listen to it or do I need to turn that emotion off?
Yeah, I think that's a great point. We have to understand our own bias. And I think some of us are prone to be, I'm prone to be optimistic, right? I always want to see the best in people. I want to see the best in businesses, in the stock market. But at times, it's hard to be optimistic when everybody in the room is ultra pessimistic, right? It's
and that's what happened back in March of 2020. pretty darn pessimistic, right? This was our fear side. March 12th, 2020, only 1% of the S&P 500 closed. 1%. 1% closed above their 50-day moving average. One of the most oversold readings in history. Maybe the most oversold reading in history.
There was 5 companies.
That's crazy, right? You got a sea of red. I don't know if you've seen that tweet. I'm not much of a Twitter fan, but there was a tweet that had Powell, and then it had him with the back screen of
all the stocks red.
All the stocks red in the background. Right? It's like he is powering those stocks into the ground. The S&P 500 was in the midst of a crash in March of 2020. It was down 27% from its February high. Not a far cry from where we find ourselves here today. We're recording right now on June 21st of 2022. It was in the midst of a crash, down 27% from its February high. And we have to ask ourselves, what happens next, right? The markets at that time were extremely oversold when we look at it from a historical perspective. And what happens when markets are extremely oversold is they tend to bounce back with above average forward returns, not just a little bit, right? The annualized returns moving forward for the next 1, 2, even just the next 30 days in those types of conditions are pretty dramatic. Over just a 30-day period following the bottom 2% of extremely oversold conditions, we see a 4.2% average return versus 0.8% for all readings historically. And I think another thing to point out there, 0.8%. So 0.8% is the average 1-month return of the S&P. Multiply that by 10, that's 8%, right? We're getting close to that 8-10% average annualized return of the S&P 500 over the long run. But in these extremely oversold conditions, boy, 4%, now we're talking 42, we're talking about 46, 48% at the end of the day. So that's a pretty huge return in 30 days in these extremely oversold conditions over a 2-year period. That's a 49% average return for the S&P 500, which on average is 23.8% over a 2-year period. Well, it's about 10% per year, right? So that's a 25% differential. So in those extremely oversold conditions, I think this is what we would expect. We would expect if the market's very oversold that it should revert back to a mean, or we should see the market recover. That's what's happened historically, and this is why these are always good times to buy. When you're in an oversold condition, you buy. When everybody's being fearful, it's time to be greedy.
Yeah, I always joke that the stock market's the only market in the world where people run for the exits when it's on sale, right? 20-30% declines. It's like, I think I want to sell. And we all know that that's not going to be in your best interest, but it's just this terrible tendency that we have when the stock market goes down to want to sell.
Not the paradox. This one makes sense, right? And this is exactly what we would expect. Right. Now, what about the greedy side of things? So May 28th, 2020. Woo! Just 2.5 months later, 96% of the stocks in the S&P 500 would close above their 50-day moving average, which at that time was the highest reading ever recorded. And the S&P rallied 40% from its lows in March. By all accounts, now it's extremely overbought. What happens when stocks are extremely overbought?
Well, you would think they would go down, right? Revert to the mean.
Yeah, you'd say, oh, well, they've got to go down. This is when people tend to get concerned. You would think, hey, the market's done really well. Maybe I should move some money to the sidelines. I will say this. On a side note, though, I don't tend to see that, right? When we're sitting down and meeting with people over the last 20 years that have been doing very well in the stock market, they go, well, I don't want to get out now. I feel like it still has room to run. I feel like it still has room to run. I feel like it still has room to run. And guess what? It tends to move higher with above average forward returns when we're at the other extreme. When we're at the other extreme, when we're at the overbought conditions, the market does perform better over these 1 month, 1 year, 2-year periods than on average. And that's what happened back during that time period, rose another 60% to its peak in early January of 2022. And what were those returns? So if we look at overbought, the top 2% of overbought conditions, 1 month returns 1%, not a whole lot different than 1 month long-term returns of 8.8% or 80 basis points. But the 2-year is a little bit more significant, right? Over the next 2 years, overbought conditions lead to about a 32% return over the next 2 years. And that is versus about 23, 24% over all the other readings that are out there. I think that's the one that is going to catch you off guard, right?
Yeah.
You're going to, well, that's overbought. You know, we're headed for a pullback. But that's not what tends to happen. And we'll talk about why that tends to happen here in just a moment. But let's go to fear. Just most recently. So June 16th, 2020, we've seen about a 24% decline in the S&P 500, one of the worst starts to any year throughout history.
They love to throw that in there. This is like the worst ever.
Which should tell us what? We're about to have the best ever? Is that what this is trying to tell us? And today, only 2% of stocks in the index remain above their 50-day moving average. This is the fewest that we've seen since March of 2020. What happens when things are extremely oversold? They tend to bounce, right? They tend to bounce. They tend to bounce quite dramatically. And I also think there's another thing that this chart doesn't go into. It's only showing 1 year, 2 returns, 2-year returns. I want to see 5-year returns. I want to see 10-year returns, right? Because if we suffer a 50% loss, what's it take to get back to even? It takes 100% to get back to even. So just because markets are extremely oversold right now, maybe you've taken some hits, it doesn't mean over the next 2 years it's going to actually recover, right? It could continue to trend lower because not every bear market is exactly the same. We saw this in 2008. Right. The market could continue to trend lower, or maybe just takes a longer period of time to get actually back to even. And that's what we've seen in some of these past bear markets. If we go to another article that we included in our weekend reading for retirees, you know, we look at the break-even point from being down 20% in the market. So down 20%, that officially puts us in the bear market. On average, it takes 25 months to get back to even when we're down 20%. But there's been periods of time throughout history when it's taken much longer than that. If we look at 1973, it took about 56 months to get back to even. 1946 took 37 months to get back to even. 2000 and 2002 took 67 months to get back to even, right? We're talking about more than 5 years to get back to even. And if we look at some of the numbers that are being given in this particular article, they're taking a look at the next 2 years' returns. They're not talking about breaking even, right? They're talking about, yes, the market tends to perform very positively in extreme situations, extremely overbought, extreme oversold. Extreme strength begets strength, right? And that is momentum, right? We get momentum in the markets, and greed takes over, and it continues to go higher. Extreme weakness does the same thing. Now we tend to revert back to the mean, and that just shows us that the most powerful forces in the market are fear and greed. And I think it also shows us, when we combine both of these different articles, there's a lesson in there for a retiree, or even a young business owner, or someone that is a younger investor, right? Someone that might need some cash at any time over a 5-year window. We can see that if you are 100% invested in equities, it can take you 5 years or more just to get back to even. That doesn't mean you're actually getting any returns, right? We could say from 2000 to 2012, the market was flat, right? So we had a pretty extended period of time when you wouldn't have seen any returns. And for a retiree that's taking distributions during that period of time, well, they're going to have a very painful time in retirement, one that might jeopardize all of their retirement.
Yeah, absolutely. And so you talk about those sequence of returns. It's the returns that you receive at the start of retirement. And if you look at the chart, the article you were referencing was from Ben Carlson, showing those months from down to break even. It's like you have to have that cushion, right? You have to have that ability to allow those equity positions to come back. You have to be, have a long enough time horizon to be able to rebalance and not panic sell in those instances. But I think you talked about business owners, you talked about young investors. I think this is the anti-YOLO argument, right? All the people that we saw just dumping tons of money into equities and maybe crypto. It's like, hey, always keep some cash, always keep a safety net, always keep some liquidity. That's why we always preach that for retirees.
Real wealth is made in cash, not in stocks.
Yeah, and I think those folks holding cash the last few years were so disappointed. How many conversations do we have with retirees that just complain so much about the return on their savings or their money market or their CDs? It drove all that money into equities, and then what happened? It's like, keep that cash, no matter how low the yield is. Keep that, what do we call it in that one podcast? The war chest. You got to stock the war chest.
Stock the war chest.
And be prepared, because if you look at these returns, 49% from the bottom or 37% from the bottom, it's like, well, if you've got an extra bit of cash on hand, it's the time to buy. It's the time to allocate to those things that are down so heavy. And we're seeing it across the S&P. Another article here, more than 90% of stocks last week in the S&P declined in a single day. It's the 5th time in the past 7 days since 1928. There have been exactly 0 precedents for 90% of the S&P declining for 5 out of 7 days in a row. That's extreme oversold.
Yeah. And so for younger individuals, we're saying what? And even if you have the ability to do this as you're maybe not in retirement, maybe you just have some cash, stack some of that cash, reinvest it in the markets. These periods of time when we enter these extremely oversold conditions are a really good time to get back to even. Jeremy Siegel of Wisdom Tree, who we're actually going to have on the podcast here next week.
Can't wait.
We're actually going to be talking to him about his thoughts around that, right? He says that if anyone buys into the markets right now at, say, 24, 25% down at the time that he released those comments, they're going to be very happy a year from now. They're going to be ecstatic 2 years from now with what's happened. And we can see that by just looking at the historical statistics. You're correct. However, someone that is already invested in the markets, they've experienced a 25% drawdown, they may not be thrilled 1-2 years from now. They may not get back to even 1-2 years from now. The market may trend down to 35% or 45% down this year. We don't have that crystal ball. And that means it might take 3, 4, 5 years to get back to even. And so for our retirees, the families we're working with, this is why we're always preaching that we need to secure those first 5, even 10 years of retirement income needs so that you can have at the bare minimum the confidence to know that you're going to be okay when we go through these periods of time. And I think from a technical perspective, 5 years of guaranteed income set aside, perfectly fine, right? That is going to be enough to take care of these extreme circumstances where you can let the equity portion of your portfolio rebound. However, I like to see 10, right? I want to be in that 10-year of secure income world, because if I'm in that world, I think, yes, from a technical perspective, I'm fine over 5 years. But when we meet with people that are 5 years out from retirement, let's say they're going to retire when they're 65 and they're 60. At 60, they're concerned right now. And that same thing's going to happen in retirement.
But the person that's 10 years...
The person's 55 and retiring at 65, it's like, they're not concerned at all.
Gosh, I'm glad I'm not 65 is what he's saying, right? So build that into your own plan. You talk about this all the time, buying time. You're buying time with your equity allocations, and you're layering your risk in order to invest like you're 45, invest like you're 55.
Yeah. Well, there aren't any certainties in the market. There's only probabilities. It makes sense to study these things, understand these things. That'll lead you to make better decisions in retirement and on the way to retirement. I think there's a lot to be gleaned from this, and I hope you have some big takeaways today that have a positive impact in your financial life.